All right, very good morning, everyone. It's Friday, the 3rd of May, 2024. Let's quickly take a look at overall market sentiment as we get the session underway. Now, let's take a look across the grid. We can see a fairly mixed return, I would say, for the most part this morning, looking across major asset classes. Let's start with equities. I mean, tech got a very, very decent lift last night. Strong flows in both the US as well as Asia Pacific side, with Apple obviously last night being the main focus point. They reported strong earnings as well as boosting their dividends, and also I think they announced a record, I think it's a record, don't quote me on that, but I think it's a record buyback amount of 100 billion, which obviously is staggering when you think about it. And that gave the likes of the Nasdaq a nice lift. If we go to the charts quickly, gave the likes of the Nasdaq a nice pop to the upside, gave the likes of the S&P, even the Dow pushed up nicely. So nice pop to the upside in US equity futures and overnight trading on the back of that. On the Asia Pacific side, I mean, the recent upside moves that we've had in the likes of the Hang Seng, it continued. I mean, we had a huge move of over 4% at some stage for the Hang Seng, and it was also enough to lift the likes of the CSI 300 as well as the A50. Now, I maintain my long position in the A50. Remember, we got into this following the surprise rate cut by the PBOC a few weeks ago. We are now at the levels where I was aiming for from a profit point of view. But I'm staying patient because I want to see what we can squeeze out of this. If we were to get some seriously good data points coming out of China over the course of the next few weeks, I think that will just be the last check mark to get Chinese equities more attractive for investors. I mean, we have supportive monetary policy, we have supportive fiscal policy. We only really need the data, in my view, to put investors' minds at ease, saying that yes, that recovery that we've all been waiting for so long, it's finally starting to take hold, finally starting to take shape. And if we can start seeing some good data on already good and positive price momentum, I just think we can see some really big moves. And I don't want to take profit now, and see the A50, 5 or whatever, 10% higher in the next few weeks. I would rather hold on to it. And if we do get some positive data coming out of China at some stage, I would look to add some risk to that for sure. So that is one to just keep on the radar, and that's just a quick view of equities. Now, let's quickly take a look at commodities. Commodities, very mixed this morning. I mean, let's start with energy. We've got WTI and Brent crude marginally higher, but Nat gas down by over 1% or close to 1%. Precious metals was a little bit more mixed, but all three of them now trading positive. Looking at gold, silver, and platinum, of course. Platinum up big time though, but gold and silver fairly close to flat. And then, of course, in base metals, mixed as well. We've got iron ore down and copper higher. Talk about a mixed bag here, right? I mean, what was quite interesting for me yesterday, when we look at oil, though, let's just get that chart on the screen here. Looking at oil yesterday, what was quite interesting was that the oil markets just shrugged off the news that we had from OPEC. OPEC said that they could potentially extend their voluntary cuts to past the second quarter and maybe even past the fourth quarter. I mean, maybe the fact that they say that nothing is decided yet was the reason for the more muted response. But either way, you would have expected a bit more, optimism from the markets. But oil just remains super pressured. I remain very cautious on commodities in general right now. For oil, I think the fundamentals supported oil higher in the recent run-up that we had to the upside. We had a couple of good positions in that, but that we had running. But I'm starting to get a little bit more cautious now, because for me, the main reason for that prior upside was more demand focus when we had such massive upside surprises and re-acceleration in the US data. But now, after the more softish data that we've seen coming out from the US, as well as some hard data points like GDP, I think that is starting to show some possible cracks here. So that makes the demand aspect of this move for me slightly less attractive. It's a bit more noisy now, and whether it's oil or copper or gold or silver, I just prefer to stay very patient right now when it comes to commodities. Not really in the mood to trade this. Trade the markets where you have an edge. And right now, I don't think I have an edge when it comes to commodities. So I'll be watching them as always, but I'm not keen on trading any one of them right now. I would prefer to just stay more patient. Now, in terms of the bond market, pretty mixed flows, I would say as well. It's bonds still mostly higher, very close to recent highs. That means yields obviously very close to recent lows. The main focus is going to be NFP. All eyes will be on NFP, where I think the low-hanging fruit opportunity will be a miss to force bonds even higher, yields even lower. But again, we will touch on that a little bit later. But for now, yields still very close to recent lows, and don't really see that changing until we go into the NFP. Now, in terms of the FX space, the yen, the yen has seen another bout of strength during Asia Pac trading so far. I mean, dollar yen, it took out, let me just quickly show you guys here. Dollar yen took out the low, the prior intervention low from Wednesday, trading as low as 153, just below that. This is, it's a tricky one right now. Could this be additional intervention, or is this maybe just some profit taking from those big carry trades because they don't want to get run over by another attempt lower by the BOJ? I don't know, but quite frankly, guys, I just don't care at the moment. This is not an attractive trade for me at all. Whether you want to be long or whether you want to be short, for me, it's just too risky. It's too much of a gamble. I just don't see much of an edge in trying to trade this right now. Where we are, it's just there's too much uncertainty. There's too much risk. I just think there's easier ways to make money right now. Dollar yen, or yen in general, is one that I would rather opt to ignore. But obviously, for those of you that is running exposures to that, just be mindful of the additional strength we've seen. The more important one for me right now remains the US dollar, which continues to trade soft following Wednesday's FOMC, where the Fed obviously came across more dovish, especially compared to what markets had already priced in at the time. There's a very big difference between the Fed being massively hawkish and being massively dovish, and them sounding dovish and sounding hawkish. I spoke about that a lot this week, so I'm not going to bore you guys with all of that again. But the bottom line is they sounded more dovish. We had the dollar pushing lower, and that provided a fantastic opportunity for the dollar to stay pressured so far. Now, remember, heading into this week, we knew that dollar positioning, if we quickly open that up, we knew that dollar positioning, looking at the dollar aggregate view, which is looking at positioning across all of the major currencies versus the US dollar, we knew that was very stretched on the long side. So in a session like today, with sentiment skewed lower for the dollar, with the bias favoring downside for the dollar, I would prefer shorts, but the main event and risk we need to watch, of course, is NFP. Now, on that front, I think Wednesday's FOMC means that there is a pretty high bar for an upside surprise. Not in terms of how the data surprises, I mean in how the markets react. I think there's a pretty high bar for any upside surprise to see a big reversal in the moves that we had from Wednesday. Because think about it this way. If the Fed, even after the recent inflation surprises that we've seen, if they remain adamant that it is unlikely that their next move will be a hike, then arguably the size of the upside surprise that we would need to see to change that is a very sizable print. Arguably we would need to see jobs coming in above the prior. We would need to see that huge upside acceleration to take place. And unless that happens, I just don't see, it's going to be a high bar. That's what I'm trying to say. So in other words, after Wednesday, and with the current sentiment still negative on the dollar, with positioning still stretched on the dollar, the risk event trade, the trade that I'm hoping for as a risk event trader here is that NFP comes in massively lower. If we see a surprise miss, I just think that'll set up the perfect opportunity for decent additional downside here in the US dollar, and something that could have nice spillover effects going into next week as well. So from a risk event perspective, hoping for a miss, but even if we get just an as expected print, which will still show deceleration, maybe that could be enough for some dollar downside. Obviously, I would prefer to get a miss. Always more attractive to trade something that's got a little bit more teeth to it, but even an as expected print or just a marginal miss, it could be enough based on the sentiment and after the FOMC on Wednesday. But I will have a full preview available as usual. That's just a quick view across major asset classes, looking at sentiment. And as always, any questions, don't hesitate to let me know.